What's up, my money movers? Welcome back to another episode of the Do.Different.Better show, where we break down wealth wisdom and money moves for everyday people looking to level up their financial game. I am your host, Elaine Rasmussen, CEO and founder of Social Impact Now, Connect Up Institute, and managing director of the Integrated Capital Fund. And today we are diving into one of the most hyped and most misunderstood and potentially most lucrative financial strategies out there. And that is day trading. I was in the gym and I was thinking about what was I going to do my next episode on. And I was playing tennis with somebody in a class. And afterwards, we were kind of talking about what we do. And she was telling me that she does day trading. She does it basically full time. And I was like, oh, wow, this will be a great episode. So I hope you're looking forward to it. And here's another reason why this show right now today is going to be great for you. Day trading is often glamorized as fast money, fast trades, quick profits. But what's the reality? Can you actually make a living off of this? And is it worth the risk? Well, I'm going to break down what day trading is, how it works, and what you need to know before even thinking about jumping in. Here's a fun fact. Did you know that nearly 90% of day traders lose money while only 10% actually turn a profit consistently? Yep, we're cutting through the hype and we are giving you the real deal. So, here let's jump into it. First, let's define what day trading is and how it works. Then we'll look at the different markets where day trading happens. Finally, I'm going to walk you through real world examples of a day trade. So, if you've been thinking about diving into the world of fast paced day trading, this episode is something you don't want to miss. Don't forget to share it if you know somebody else is really interested in day trading. So, first, let's talk about what actually is day trading. Day trading is the act of buying and selling financial instruments, whether it's stocks, bonds, whatever, within the same trading day. That means you never hold a position overnight. It's different from long term investing that we've talked about on the show because day traders aren't looking for slow growth. They're looking for quick profits from short term market movements. So you might be wondering, well, how do day traders make their money? They make their profit from small price movements in highly liquid stocks, foreign exchange, crypto, or futures. They use technical analysis, real time data, and chart patterns to identify quick buy and sell opportunities. So, here's how it differs from long term investing. Long term investors look for value and hold assets for years. Definitely at 1 year, but definitely 2, 5, 10 years. Day traders focus on volatility and liquidity, making money from frequent small price swings. So remember, we've talked about what liquidity is. Liquidity is how much cash is on hand that you have readily available in a very short period of time. That's what we mean when we talk about liquidity. But I'm going to go into an example just to highlight this. An investor might buy Apple stock and hold it for 10 years. A day trader might buy Apple stock at 9:30 a.m. and sell it at 9:45 a.m. for a quick profit. Day trading versus swing trading. So, day trading, all positions are closed by the end of the day. There's no overnight risk. Swing trading, trades last for days or weeks, capturing large price movements. So, but here's the key takeaway. Day trading is not passive investing. It is active, it is high risk, but it's also high reward, and a strategy that requires skill, discipline, and a solid strategy. You're going to really kind of want to know what's your risk level. You're going to want to know how much do you have to play with. So you're really going to have to think about, am I looking for 5% growth every day? Am I looking for 10%? Like, and what is the sectors that you're going to like actually make movement in? So, what are the markets that you can actually day trade in? The first one is stocks. And that's actually the most popular for day trading. Traders look for stocks with high liquidity and high volatility and volume, like a Tesla, an Amazon, are NVIDIA. Pre-market and after-hours trading is really about institutions dominating and making it harder for retail traders. Then there's Forex, which is foreign exchange, trading currencies. That could be the US dollar, it could be the euro, it could be the Japanese yen. These are the biggest markets in the world. It is $6.6 trillion are traded daily. So there's 24/5 training, right? So unlike stocks, the foreign exchange market never sleeps during the weekdays. It is always on. So 24 hours a day, 5 days a week. So just know that foreign exchange market is constantly going. It's like New York. It never sleeps, right? And then finally, there's crypto. And some of the big ones that you may have heard of is Bitcoin or Ethereum, and altcoins can be day traded on platforms like Binance or Coinbase. They are also really known for their high volatility but big profit potential, but there's also some risk, and we'll talk about those later. And then finally, there's futures and commodities. So commodities, those are things like gold, oil, agriculture, and stock indexes like the S&P 500. These are used by hedge funds and institutional traders. So just to talk about commodities a little bit. So commodities, think about commodities as something that there's no necessarily unique value to any distinct piece of that thing. So when we talk about agriculture, corn is corn is corn, right? There isn't really much different between corn. There really isn't much difference between gold. Gold produced by one manufacturer or held by one person is not much different than gold held by another person. So, or mined by another person, by another business or organization. So, that's what we mean when we're talking about commodities. Commodities are just things that like they are maybe made by multiple different people, but there's no distinct difference between one owner or one manufacturer of that particular item. So now we're going to be talking about choosing the right market. Okay. So which one of these four things that I outlined could be the thing for you? So, first, if you like trading during regular market hours and want a mix of stability and volatility, then stocks are going to be the thing for you. If you're really looking for 24-hour access, maybe you have a schedule that's maybe outside of the normal 9 to 5 hours, Forex might be good for you. And there's lower capital requirements to get into the foreign exchange currency market. Crypto, with as it relates to crypto, if you want high volatility but are okay with the wild wild west of digital assets, then crypto could be the thing for you. And then finally, as it relates to futures, if you want to trade in broad market movements and hedge against inflation, then that's really going to be the futures and commodities is really going to be the thing for you. So, but here is how I want you to start to craft an action plan. Pick one market that aligns with what you think your trading style might be, especially if you're just getting started. And I want you to start studying it before you start making any trades. You'll start to maybe see what are some patterns, maybe not necessarily patterns minute by minute, but maybe you'll start to see, hey, I'm noticing on Mondays this kind of activity happens. I'm noticing at 3 o'clock on Thursday, this kind of activity happens. You might start to see patterns or what are called in the technical terms, algorithms. Algorithms are just highly computed ways of looking for patterns, right? But you've got a great computer that's called your brain. So if you just have to be noticing and studying what's happening, maybe you make notations, maybe you have a spreadsheet where you start to see where are things, where if you can see opportunities where there are patterns in some of the activity. But definitely start looking at this and studying it before you actually make your first trade. So, once again, I promised you that I was going to give you a real world example that's a simplified day trade just so you can see how it all works, right? So, here's the scenario. Tesla, which their stock call symbol is TSLA. Their stock is trading at $800 a share. I haven't looked at the trade, so With everything that's going on, I'm not exactly sure where it's at right now, but as of the taping of this show, we're just going to use this as an example because by the time you hear this, it'll probably be at a very different price. But I just want to give you an example. So let's just say we're going to start off at $800 per share. That's what it's trading at when the market opens. So at 9:30, you see a breakout pattern forming. You enter a trade and buy 10 shares at $800 a piece. That is so you buy 10 shares at $800 a piece, that's $8,000. At 9:45, Tesla's price jumps to 812 per share. At that point, you sell your 10 shares and lock in a $120 profit. That is $12 times 10 shares, right? You made $120. But what if the trade went wrong? What if Tesla drops to $790 instead? You can set what's called a stop loss order at $7.95, cutting your losses at $50 per share, right? Which means you're going to have a $500 loss. So here's the lesson. Successful traders follow strict risk management strategies. They never hope the price will go back up. They cut their losses early and they get out. Okay. So these are some of the things that you want to think about. This is why it's a good idea to really start to study this, play with it, see what you're seeing, see really kind of understanding the dynamics of what's happening and how can you mitigate or how can you de-risk losing that $50 per share as we just talked about. Maybe you are going to lose it there or maybe you're going to hold on to it to at least get it back, later that day to get it to see if it gets back to where it was, right? So there's lots of options and we'll talk more about that, right? But here's some key takeaways from what we've just talked about. Day trading is about short-term price movements, not long-term investing. Different markets offer different opportunities. So stocks versus foreign exchange versus crypto and futures and or commodities. A trading plan and risk management are critical to avoiding blowing up your whole account and all of your finances. So, here are going to be some action steps I have for you. One, research and choose one market to study. Open a paper trading account like Thinkorswim or TradingView or Webull or Investopedia also has something. And this is where you can practice without using real money. So, that's your first step. Tell me how it's going. I want you to take a snapshot and send me a picture on social to tell me how is it going? How is your adventure going into day trading? So, you've been listening to the Do Different Better show. I'm your host, Elaine Rasmussen. Stay tuned because in the next segment, we're going to dive deeper into getting started and what are the tools that you're going to need to build a solid trading strategy. Tag us on socials. If you're considering trading, let's discuss it. Don't forget, you can watch us on YouTube at Do.Different.Better. I will see you after the break. All right, my financial tacticians, welcome back to the Do Different Better show. I'm your host, Elaine Rasmussen. In our last segment, we broke down the basics of day trading, what it is, what markets you can trade in, and real world trade example. Now, let's get into the nitty gritty. What do you need to start? What are some key strategies? And what is the actual mental game of day trading? So, day trading is not gambling, although some people would argue that it is. It's about having a strategy and sticking to your plan. Many new traders fail because they jump in head first without the right tools or the right mindset. So, I'm going to break down for you the essentials to help you start smart and avoid the common pitfalls. Here's a fun fact. Did you know that even professional traders only win at about 50 to 60% of the time? The key is really risk management and discipline. So, the essential tools that you're going to need to start day trading. is really about some basic trading strategies and setting them up so that they actually work for you. You really have got to build a really good mindset to survive the actual ups and downs of day trading, because it can be maybe a little bit of emotional roller coaster. And if you know that you are really sensitive and to volatility and swings going, that is going to be an indicator of whether or not day trading is for you. If you are not good with change, day trading is not for you. If you are not good with discomfort, day trading is not for you. If you are not good with the unknown, day trading is not for you. But if all of those things you're like, yeah, I'm okay. I don't react really quickly. I tend to be, a steady person. I am good with navigating change. You might want to think about day trading. This might be a good thing for you. So, the first thing you want to do is, if you're going to be using a broker, you want a broker that offers really fast execution, low fees, and a solid trading interface. Some of the popular platforms, and they're not sponsoring this show, but there's Thinkorswim, which is done by TD Ameritrade. This is great for analysis and paper trading. There's also Webull, which is really good for beginners with some commission-free trading. And there's also some interactive brokers that are ideal for people who are maybe a little bit more seasoned, or once you get a little bit further in your day trading journey. And these platforms have low spreads, and they are great for high speed execution. Then there is TradingView, which is excellent for charting and technical analysis, right? So once again, these are really great. That's the first thing. So you want to have a really, really solid platform. Okay. Next, you really want to have some charting and analysis tool. Day trading is all about reading charts. So once again, if you're not good at reading charts, but you want to learn, this could be great for you. If you're just like, hey, reading charts and analysis is not my thing, then day trading is not going to be for you. But you are going to need a platform that has real-time price data, some custom indicators, meaning that you can make some tweaks to be able to give you signals, like moving averages, RSI, MACD, or Bollinger Bands, right? So these are all abbreviations. We'll get into those in another show. But these are drawing tools for trend analysis that can help support you and give you some resistance levels, and let you think about it as providing you with a rubber band to be able to kind of know what's going on, right? The next thing that you're going to need is, you're going to need fast and stable internet connection. So I would not recommend doing day trading at the local library, right? There, you might get bandwidth slowdowns, which is going to reduce the speed at which you're going to get information, which then could impact when you trade, how you trade, and how profitable or how many losses you're going to see in your trades. So, day trading requires split second decisions. A slow connection can mean missing a very big trade or taking a very big loss. And I would hate for that to happen to you. So, number four, you really should keep a trading journal. Pro traders track every single trade. This helps you to start to see, once again, patterns and identify what's working and what's not working. Using a spreadsheet or a tool like Trader Sync or EdgeWonk to log your trades could be a good mechanism for you. The next thing is, you want to have a risk management plan. Every trade should have a stop loss. A stop loss is an automatic exit if the trade goes against you or goes against what you had mapped out or planned, right? Never risk more than 1 to 2% of your total account on any single trade, right? So this is really about making sure you're making incremental increases. Once again, not these large trades. Although that doesn't mean that it won't happen. It could happen. You can have a day where, hey, the trade, increases by, 30, 40, $50, or maybe $100, and that could be great. But that is not going to be forever. So once again, you want to take all of that into consideration. So think of it this way. You wouldn't want to start a business without really good tools, right? Day trading is exactly the same. You really need to have the right setup before you make one single trade at all, right? And maybe a good way to think of it is this is a business. So, how do you want to think about running this business? What kind of time are you going to dedicate to it? Are you going to be coming to it at the same time every single day? Are you going to be watching it through the day? Do you have a lifestyle or a job that would allow you to do that? Because what you certainly don't want to do is go down a rabbit hole doing this and not do your other responsibilities, especially if you have a job, correct? Okay. So, here are some basic trading strategies and how to get them set up. So, the first one is what's called scalping. These are what are fast and furious trades. They are holding trades literally for seconds to minutes to catch really small price movements. Here's an example. Buying Apple stock, and their call symbol is AAPL when you go look at the stock market. So buying Apple stock at $180.50 and then selling it at $180.80 for a quick 30-cent gain on per share. So, this is really good for traders who can make fast decisions and handle intense trading. Once again, if really fast and furious is not the thing for you, if you don't see that showing up in your regular life, it will not do, you cannot do it in your trading life. So, really, I want you to think about how do you manage your other decisions? Are you the kind of person? I was just talking with an entrepreneur the other day, and she's like, yeah, I'm really slow to make decisions. Okay, day trading then is not for you. If you need to talk to 10 people, you need to have 5 sources, like then day trading is not the thing for you, especially with scalping. It is really about quick, fast decisions, making decisions in like 60 seconds or less. So that is, if that's not for you, that's probably not the place where you want to start. Maybe you'll get there, but it's not the place you want to start. Okay. Then there's what's called momentum trading or riding the trend. These are trading stocks that have stock prices that move due to news or earnings or volume spikes. An example of that would be a bio stock that jumps 20% after the FDA approves them. Excuse me. The momentum traders jump in early and ride the trend up and then get off. So think about, I don't know, for some of you, especially my Gen Xers, we used to get on those we used to have those whirly things that in the playground, and you'd have one friend whose literally was job it was to get the thing going as fast as possible, and then that person would jump on when that thing was going around the speed of light. That's kind of like what we're talking about. That's momentum trading. You're like trying to ride the trend and get on as it's going faster and faster and faster, and then obviously you want to jump off when you start to see the dip going down, right? This is really good for traders who can identify high momentum stocks and enter before the trend starts to fade. I once had a friend of mine who did day trading, and he said, it's think about you are riding a train and it's going around a blind corner. And so, as soon as you start to see it going around the corner or you start to see the tail of the train, that's maybe the time to get off, right? So, that's how he looked at when he was doing trading. The third way mechanism is what's called breakout trading. This is buying the break of key levels, right? So this is looking for stocks that break through major resistance levels on high volumes. So here's an example. A stock has been stuck at $100 for weeks. One day it breaks above 100 on a strong volume. This signals that there's going to be a breakout, that it's going to be on the move. Now, is it on the move up or on the move down? That's what you got to watch for. But obviously, if you see it go up incrementally, there's a good chance it's going to keep going up for a certain period of time. Not a sustained period of time, but a particular period of time. Maybe it's a day, maybe it's a week. But once again, depending on your trading strategy, if you're just in it for the minute, great. If you're in it for the day, great. If you're in it for the week, fine. But then if you're getting any longer than that, now this is a buy and hold for you, okay? And you've now moved it from a day trade to part of your investment portfolio, okay? Your longer term trading. This is really good for traders. This tactic is really good for traders who use technical analysis to find pricing patterns, okay? Then Number four is reversal trading. This is catching trend changes and finding stocks that are overbought or oversold and betting on a reversal. Some of the indicators that will be used are RSI, which is a relative strength index, or MACD crossover. So here's an example of that. A stock drops 15% in one day, but bounces off of a strong support level. A reversal trader would go long and expect a bounce, meaning they're going to hold it for a while and then they're waiting for that bounce. This is really good for traders who can spot a trend exhaustion and trend against the herd, right? So let's say that something is happening in a particular industry, and what's end up happening, that something like this will be really good when we started to see Blockbuster, and when we started to see Netflix coming out with mailing out DVDs instead of having to go to the store. That might be a trend where people aren't really convinced that that's going to be the thing, or live streaming is going to be the thing. But you as a trader are now investing in that, because you're like, no, people go, the days of people going in and actually borrowing VHS and DVD tapes is ending. So I'm going to hop on this trend that's maybe going against what everybody else is saying, which is no, people are still going to want to go and borrow tapes and rent tapes from the store. And you're like, no, I actually see that no, people are going to be going in the other way. And obviously that's exactly what happened. And that's why some of you listening to this have never even heard of Blockbuster. But I encourage you to look it up. It's a great case study on really understanding your customer and where the market is moving, and are you actually relevant and meaningful. But it's a really great tactic when you start to think about from a trading perspective, is how you can think about, where are you going to go with the herd, and when are you going to go against the herd, right? People who go against the herd, these are really people who are early adopters. Maybe if you were, I was one of the early adopters of the BlackBerry phone. Once again, if you've never heard of BlackBerry, you look it up. But I was an early adopter. Everyone was saying that it was going to be ridiculous to use a keyboard on your phone, and it became one of the biggest things. And it was one of the last stalwarts before Apple came out with its with its in phone keyboard, without having a hard clickable keyboard. But here's some things. I digress. Really want to think about risk management for your strategy. Okay. Setting a stop loss on every trade. This limits your downside. Once again, I really want you to think about never risk more than 1 to 2% of your total trading capital on any single trade. And I want you to always set a profit target and don't get greedy, right? That's actually gambling. So here's your key takeaway. Pick one strategy. I want you to master it, and don't try to trade every setup. You will spread yourself way too thin. Okay. So next, we're going to get into, as we kind of move into the end of this segment here, I'm going to be talking about the mindset of a successful trader. So I really want you to start thinking about how you can control your emotions. Okay. If you trade emotionally, you will make bad decisions. So here's a solution: have a trading plan and stick to it. Number two, patience and discipline. Most trades are not worth taking. Pro traders only take high probability trades, they don't chase random moves. Okay. You don't need to trade every day. Some of the best traders only trade a few times a week. Number three, handling losses. The hard truth about trading: even the best traders lose money regularly. The goal is to win more than you lose over time, right? If you win 60% of the trades, but keep your losses super small, you'll be profitable in the long term. Number four, building a long term mindset. Day trading is a business, not a get rich quick scheme. Start small, stay consistent, and build your skills. Think months and years, not days and weeks. So, here's some key things that I want you to take away. If you can't control your emotions, you can't be a day trader. Mental discipline is just as important as having technical skills. So, Now that we've covered all of this, here are some of the top key lessons I hope that you're taking away from this particular segment. Choose a trading platform, get your charting software, and have a risk management plan. I want you to learn one strategy at a time, whether that's scalping, momentum trading, breakouts, or reversals. You're going to need to manage your emotions. Trading is 80% psychology and 20% strategy. And here is my action step for you. Open a paper trading account and test one of the strategies without real money. I want you to also set up a trading journal to track every trade that you make. So, now that we've wrapped this up, I want you to stay tuned for the next segment where we're going to dive into the dangers of day trading, some of the common scams, and how to protect yourself. But don't forget to subscribe and leave a review. Tag us on the socials. What strategy are you most interested in learning more in? Let's discuss it online. And also, I'm going to be providing you with some free trading starter guides. So make sure that you follow me on socials at Do Different Better, Do Different Better with Elaine. And we're going to start to get into the next segment. So I will see you after the break. Thank you for listening to the Do Different Better show. I'm your host, Elaine Rasmussen. Welcome back, my money moguls, to the Do Different Better show. I'm your host, Elaine Rasmussen. And as we close out this episode, we have covered the basics of day trading, how to get started, and some of the strategies that really, really work. But today, I'm also going to talk about the reality check. That is the dangers and some of the straight up scams in the world of day trading. So, over 80% of day traders lose money within their first year. It's not because they're not smart, but because they weren't prepared. There are countless scams in the day trading space, from fake gurus selling useless courses to pump and dump schemes. We want to arm you with the knowledge to trade smart, stay safe, and protect your hard earned money. So, here's a fun fact. Did you know that only 1% of day traders are consistently profitable over time? The other 99% either burn out or blow up their accounts or just quit. So, you've got to really want to think about doing this and dedicating energy. The biggest risk of the day trading is how to manage your trades. Now, here are some common scams and red flags to watch out for and building your long-term sustainability trading plan. So, the reality is that how are you going to deal with losing money? So, first and foremost, let's get real. Most traders will experience losing streaks. If you're risking too much per trade, one bad week can wipe out your entire account. So, here's an example. A trader with $5,000 in their account risks $1,000 per trade. 5 losses in a row, and they would be out. That's it. They'd be wiped out and they'd be starting for zero. So, how can you manage this risk? First is really setting up a daily loss limit. Stop trading after hitting a predetermined loss amount. Once again, never risk more than 1 to 2% of your entire account per trade. Also, have a stop loss in place for every trade. Your stop loss is going to be you are trading you will stop after this certain amount. It's going to sell after it hits a particular amount. Okay. And you can set those up in the platform that you choose. Okay. Number 2, emotional trading and revenge trading. Okay. Losing money can make you emotional. You might try to, I'm going to win it back. That's when you start to move into a gambling mindset. And by winning, if you're going to think you're going to win it back by taking bigger and riskier trades, this is called a revenge trade. So here's an example. A trader loses $500 on a trade, gets angry, and then doubles their next position size to make it back and loses even more money. This is what you see when you go to the roulette wheel or when you go to the blackjack table. You'll hear somebody say, hey, I've already lost $1,000 to the house. I want to get that $1,000 back. And then you see them at midnight and you're like, they're now down another $20,000, right? So this is where the difference between when we talk about trading and gambling, even though some people may call day trading gambling, it is gambling if you're using these kind of tactics of I lost money and I'm going to try to win it back. That's when you start to move into gambling. So but here's how you can manage that risk. I want you to stick to your strategy. Don't trade based on emotions. It's also really helpful to take breaks. If you feel frustrated or desperate to win back losses, maybe that's the time to walk away. Maybe you need to eat something. Maybe you're hangry. Maybe you just need a breather and maybe put it down until the next day, another hour, the afternoon, or whatever. Just get your mind to think about something else and not being stuck on the fact that you made these losses. Once again, keeping a journal to track your mindset after wins and losses can also show you some patterns. Do you find that you're moving really aggressively after you have a win and you're moving more conservatively after you have losses? That's not necessarily a good thing or a bad thing, but it is valuable and important information to know about yourself and how you're approaching this. I would even recommend this in your if you've got a business. One of the things that I tell entrepreneurs, I was just telling you about how I have an entrepreneur who says that she's a slow decision maker. And I said, yes. And you're in a business that where you don't always have the luxury of that time to make a decision. So one thing that's really important that I like to tell people to do is creating a decision matrix. And a decision matrix is understanding how do you make decisions. The goal isn't necessarily to change how you make decisions. That's a very deep woven neural pathway that could take years of therapy to undo. So we're not here to change how you make decisions. But once we understand how we make decisions, meaning I need to talk to 3 people, maybe you need to talk to a spiritual advisor, maybe you need to talk to your parents, maybe you need to do some research on Google, maybe you need to go ask a librarian. Start to notice what are all the things that you find that you do when you need to make a decision. Maybe it's talk to a sibling. Maybe it's talking to a particular friend who's hyper analytical and non-emotional. Whatever those things are, make a list of those things and then putting a time period on them. How long does it take you to do that? Hey, it normally takes me 2 or 3 days to catch up with my parents and then have a conversation with them. And then it takes me another day to think through what they've given to me. Once you start to understand how you make decisions, now you can start to understand your process. And now you know, oh, it takes me a week to make a decision, or oh, it takes me 5 days or 4 days to make a decision, or it takes me 3 hours to make a decision. Once you have that information, now you know when you need to make a decision how much time that you are going to need, and you know what the process is. Because sometimes, if let's say you need to make a decision in 3 hours and you have a decision matrix that requires you 1 week, well, now you can start to see what can I actually take off this list, but still get myself a level of confidence in making my decisions. So I know that was a little bit of a rabbit hole, but I think it's really valuable and important to understand how you make decisions in general in life, because that's certainly going to influence how you decide to make decisions when you become a day trader, if that's what you decide to do. So, number 3, over trading. Making too many trades or not enough trades is something to think about. Some traders think that they need to trade all day, every day to make money. But more trades, and that thinking that more trades equals but more trades actually mean that there's more opportunities to lose money. So saying that I'm only going to trade for an hour and that hour is going to be at 7 a.m., maybe that's the thing that you need to do. But so here are some of the things I'm going to tell you for you to be able to manage your risk. I want you to only take high probability setups that match your actual strategy. So if your strategy is, I want to make $100 a day, okay, that's a strategy. Maybe it's you want to make $500 a day. That's a strategy. Maybe it's you want to make $50 a day and 3 trades. Okay, that's a strategy. So these are the things that you want to match up with your strategy. Next is you want to set a limit on how many trades you'll make per day, right? Is it 5? Is it 10? Is it 20, right? Obviously, in the beginning, that's going to be a lower number than as you start to get more experience and you feel more comfortable and more confident. Some of the best day traders only trade for a few trades a week, period, right? But here's one of the key takeaways: day trading is about discipline. Gambling is actually being reckless and having no plan or strategy. If you don't control your risk, you will blow up your account and possibly your life if you are putting a significant amount of money in this, which I highly discourage you from doing. Do not put money in day trading that you cannot afford to lose. Point blank, period. Okay. Now I'm going to talk about some common scams and red flags. So the first one is fake trading gurus and get rich quick courses. You see them all over social media, people flashing luxury cars, claiming they made millions in a month with their secret strategy. What they're doing is they're selling overpriced courses and signals that don't actually teach you how to trade. They may sucker you into buying more content from that person or booking time, a one-on-one session with them, which they also don't tell you. There is actually a whole industry that is set up to teach people on how to not teach people things and make money off of that, and just continuing to upsell them, but never really teaching them. There's a whole industry, there is a whole seminar industry about teaching people to become subject matter experts and never really give out the expertise of that subject. So be careful. Here's another red flag. Here's a red flag. They promise you guaranteed results. No strategy works 100% of the time, period. Sometimes they're posting lifestyle flexing, like fancy cars, stacks of cash, exotic trips, maybe a dude with a whole bunch of like half naked women around them. Consider that a red flag. Immediately a red flag. Okay. Also, they charge thousands of dollars for some basic trading information that you can find for free online on Google or YouTube. So, but here's what I would suggest that you do instead: follow real traders who focus on education over hype. You can learn from free or low cost sources like books, YouTube, or trading simulators. And I talked about some of those earlier, right? Practice on a paper trading account before risking any real money. Okay. Here's the second one you want to be careful of: the pump and dump scheme. A group of traders will hype up a low price stock, often penny stocks. They buy early, they get retail traders to jump in and then sell for a profit, leaving everyone else with the losses, right? Here are some red flags to signal to you that that's happening. Sudden stock spikes with no real news about what's going on in the industry or that particular company. So also, social media gurus promoting a stock super, super aggressively. Another one is big price jumps followed by an immediate crash. Those are all great signals to let you know that this is a pump and dump. Here's how you can avoid this trap. Do your own research. If a stock is skyrocketing, ask why. Look at the volume. Pump and dump stocks are often huge volume surges followed by a big drop. So don't blindly follow social media picks. There's a great movie on this. Uh, oh, Boiler Room. It's a great movie. I mean, it's actually, there's great acting in it. It's not a great movie, but it's really great to really understand day trading, and it all focuses on a business that all they do is pump and dump. Giovanni Ribisi is in it. He's great. Nia Long is in it. She's amazing. I definitely encourage you to check it out. But just know that these folks are just horrible, horrible. And so just be mindful of what that looks like, right? And avoiding those. Okay. So I really want you to start with a plan. That is going to be the key to your success. Start small and scale up. Don't go all in on one day. Start with a small account or even a paper trading account. Maybe start with $100. Set goals and focus on learning first, not making fast money. So, for example, aim for some consistent small gains instead of swinging for home runs, right? Two, I want you to have a trading plan. Every trade should have an entry strategy when you're going to buy, a stop loss when you're going to exit if the trade goes bad, and a profit target, which is where you're going to make all of your gains, right? So the third thing is knowing when to walk away. If you lose more than your daily limit, Stop trading. Take breaks. Some of the best traders take days off just to avoid burnout. Don't force trades. If nothing looks good, it's okay to sit it out, right? That is okay. It's okay to walk away. Okay. So here's my call to action and some of my final thoughts that I want to make sure you're walking away with. Okay. So the first thing is day trading is risky. Like I said, only 1% of traders succeed long term. So just make sure that you're taking care of yourself. Okay. Next, avoid scams and fake gurus. There are no shortcuts. There really isn't. Finally, I want you to manage risk and have a solid trading plan. So here's my action step. I'm going to be giving you my starter guide for free. It's going to be DM me on my socials and I'll make sure I get that out to you. But I really want you to start working on this. You know what? Maybe it's not something you do forever. Maybe stick to it for 30 days and see what happens. But I want to encourage you to follow us on social media. I want you to tag us with your biggest takeaway from this episode. And if you found this episode valuable, leave a review and share it with a friend. So here's just my final closing thoughts. Success in day trading isn't about making big bets. It's about making smart, calculated decisions over time, staying disciplined, staying informed, and most importantly, staying in control. That's a wrap on today's episode of the Do.Different.Better show. Thank you for tuning in. I'm your host, Elaine Rasmussen. I can't wait to see you online. Remember, you can watch the show on YouTube. And also remember, your path to financial freedom starts with doing something different every day. So go out and take action. Look for me, subscribe, don't forget to leave a review and share this episode. Thank you so much for joining me. And I can't wait to see you next time when I show you how to do different better.